Most people think retirement means saving forever. Well, today I'm going to show you a simpler strategy that I plan to use to generate premiums in my retirement years. What is going on, premium chasers? I hope you're having a God blessed day. Today, every single person that comments down below is going to get my brand new ebook called The Theta Decay Hit List. It's an absolute must read for options sellers. All you have to do is drop a comment. I'll personally send you that out. And also, while you're down there, hit the like button, hit the subscribe button. But today, guys, we're going to be talking about one of my favorite topics ever, and that is retirement, early retirement, right? Financial independence, retirement early crowd, the FIRE people. Because I think that system is absolutely broken because it's telling you to basically pinch pennies and really take away from your current life in order to live later, which we don't know if that's not a guarantee, right? So, one thing that I have really focused on heavily over the years is selling options. Now, I know options might sound like the scariest thing. You've probably done it before and you lost a amount of money, but listen, give me like 5-10 minutes here of your time. I'm not going to waste it. I'm going to show you a strategy that is unlike anything you have seen before, especially if you're somebody that, wants to retire and actually still wants to make money, but not actually working at a job. I'm going to show you this, and you've probably never heard it before. So let's go over the shoulder. So the stock that we're going to be using here today is one of my favorites, and it's called Arista. You can do this strategy across the board, and we'll show a couple other examples as well. But let's go over, and I'm going to show you guys how it looks like, all the exciting stuff first, and then talk like logical human beings, the risks, and all that good stuff. Let's go. So first thing we're going to do is we'll just go over to Robinhood or whatever brokerage you're using. What you're going to want to do is go over to your options chain. And this is where the magic happens. And it's a little bit scary here. You probably lost a whole bunch of money in this area already, but I'm going to show you guys a better way to do things, okay? So what we're going to click is sell a put first, right? And then we're going to select our expiration date. What I'm saying here is I'm willing to buy Arista, right? 100 shares of Arista in 30 days from now. That's all that says, right? I'm willing to buy 100 shares of Arista, right, in 30 days from now. Now we get to pick what price we'd actually want to buy those 100 shares of Arista at. So let's just say you would want to buy them at 80. If Arista hits the 80, you're totally cool buying them 100 shares, right? Now for that, you would collect $250 from an options buyer. Hit the juice button. Let's get it up here. I got to hide it from my daughters, right? So right here, we would collect $255. I'm going to go just quickly toss this into our premium calculator. Obviously, all of this is for educational content purposes. All these premiums are constantly changing because the market is open. These are only the numbers I'm seeing at the time of this recording. Read the disclaimer, fam. All right. So right here, we're collecting $255. Now, remember, right, we had to put some money on the line here, folks, right? Your brokerage, if you broke and you're saying you're going to buy 100 shares, but you broke and you can't even afford those 100 shares, you can't do this strategy. So one thing to be very clear with this strategy, the more money you have, the more premium you can actually collect, okay? And that's just how life goes, guys. The more money you have, the more you can put your money to work for you, all right? And I can't stress that enough. I think you already know that, right? So 80 times 100 is 8,000. That is our collateral, right? That is the collateral we are locking up for 30 days, okay? Now we're collecting a return of 3.19% on our money. Okay, that's basically the premium divided by the collateral, and you're getting a little over a 3% return on your money, right? Our expiration date is 30 days on the money. Annualized, that's a 38% return. Now, obviously, full disclosure here, right? You're not necessarily going to be able to do this trade 12 times a year. It's a possibility, but there's a few things that can happen. So let's walk through those, okay? First things first, right? Number one, if Arista, right, stays above 80 and 30 days from now comes around, right, this day, right, or your contract will expire worthless, meaning your $8,000 will be freed up, right, to then go explore other opportunities, right? So that's option one, right? Option two is that Arista drops to 80, it drops to 75, it drops to 70. You will be buying it at $80 a share. That's why it's important to do this on high conviction stocks that you believe in long term. For me, I have a very high conviction in Arista long term. So for me, if I have to buy it at 80, even though it drops to 75, I'm cool buying it at 80. Okay, so you have to have that conviction, right? The third thing that can happen is you can close your position early, right? Let me show you what that means. Well, I'm just going to duplicate this section here real quick to show you guys how I like to look at this. I keep things very simple here on the channel, guys. I know I say it often. I'm not very smart. I like to just hone in on things and just like get as good as I can at them. But I tell you, I've tried all the day trading, that buying options, all that stuff. Listen, I ain't that smart for that stuff. I know there's a lot of people making a lot of money at that. Well, I need simple. I need stuff that I'm not babysitting stuff all day long, right? Like I'm just, again, not that smart. So I only trade a handful of times every single month, right? So right here you could see I just duplicated this out. Let's say in a week or two from now, we'll just say 2 weeks from now, Arista blows up, right? It's currently trading, right, at $84. Let's say it shoots up to like 100 or even 95, whatever. Well, your contract, your cash secured put, it's called, that you have, right, this thing that we collected 255 from, starts becoming very worthless. So worthless, in fact, that, dare I say it, we become a silly options buyer and buy to close our contract back. I know that sounds confusing, but it's not. We're basically closing our position, right? Allowing our collateral to be freed up and not having to wait this 30 days. So let's say, again, we'll put our expiration as 14 days. We say in about 15, we'll just do 15, right, for the sake of some. In about 15 days from now, Arista has blown up. It's trading well above the price of 80 that we chose to. Well, you can actually buy to close your contract, but for that means you will have to pay some of your money back. That 255 that you got up front, you may have to pay, let's say, $50 of that back, right? So for simplicity, let's just say it costs you $55 of this $255 that you got. You're going to have to pay back $55, right? Now, if you do that, your collateral now gets freed up to then go look at different opportunities. Awesome, right? Because there's always opportunities out there. We're not FOMO traders, right? We're not getting financial advice from YouTubers, right? So our return now is about a 2.5%. Is that good? Is that bad? I don't know. You got to make that judgment for yourself and what kind of like income you actually need to retire, right? Obviously, you could buy as many contracts as you want here. I'm just doing 3 contracts just to show as this example purposes. Now, we did this in 15 days, right? We were able to close out our position early, so that's going to obviously annualized look a lot bigger, right? It's going to look a lot bigger, but you know, again, it's unrealistic that you're going to be able to do this 24 times the same exact trade. I just like to look at this and make sure that my annual return is higher than my annual return on the initial one before I close out my position. Okay, so that's kind of how I like to look at that. But let's just assume this, right? Let's assume that in 30 days from now, you end up having to buy your shares, right? You end up your $8,000 taken from you. How dare they, right? And you are given back, right, 100 shares of Arista or however many contracts you opened up, right? Well, what we can do then is run covered calls. We can actually run something called a covered call, right? So on this same exact page on our options chain, we're going to click sell a call. Right now, we'll put 30 days right here. Now, let's assume we bought them for 80. Obviously, these numbers are the covered call side. These numbers are going to be pretty skewed right now, but we're going to do my best to kind of show you maybe what it would actually look like, okay? But the numbers will be skewed because if we bought them at 80, but it dropped to 75, right? Again, I'll kind of walk it as best as I can through this entire thing, right? So let's say, right, you bought them for 80, right? You bought your shares for $80, right? And then you come back in here and and you say, you know what, if it hits 85 the following month, I'm willing to sell my shares and lock in those gains. Well, for that, you would collect $400 or $390 of premium from an options buyer, right? I have another calculator here. Also, all these calculators are completely free, guys. They're inside of our Facebook group. The link is down below. All the content here is free. The only thing that costs money if you want one-on-one time, and that's our 1-year-long incubator program. Link is in the description if you want to check that out. But obviously, everything else here is free. I want you guys to use this stuff, right, and actually put it to work, right? So this is our covered call premium calculator, right? So we are collecting, what did we say? 300, we'll just say $400 because it's changing, obviously. These are just numbers and they're all for educational purposes, right? So what is our strike of the option that we're willing to sell it at, right? We're selling it for 85. selling our strike of option for $85. We purchased our shares for $80. Our premium return is about 5%. Now, this premium return will look different, right? These numbers are constantly changing, right? Because again, if Arista does drop down to these 80 levels, right, most likely we will be doing a covered call at like the 82s or 83s, right, to collect that sort of premium, right? So again, these numbers may look a little less right now because again, it's currently trading at 84, right? So this may be closer to like a 3 or 4%, okay? If we end up selling our shares, profit of 500, right? That's 800, and you bought them for 800 and you sell them for $850, right? Or $85 a share, that gives you a profit of your shares of 500 for a total of 9. Okay, so let's kind of walk through this because I know we kind of just went over a lot, right? Because I want to be clear that this example will look slightly different. Okay, now the same exact thing happens when you're doing covered calls as with a cash secured put. There's a few things that can happen here. Number one, right? If Arista, right, stays below $85, right? You said you're willing to sell them for 85, but let's say it trades sideways. It trades around $80 all month, right? And 30 days rolls around, right? Your contract will expire worthless. Your collateral, your shares will be freed up at this point. They'll be returned back to you to then do some more covered calls. Okay, right? The second thing that can happen is you could actually sell your shares. You would actually sell your shares. And if you sell your shares, obviously you would get the money and the appreciation of selling those shares. You would get an extra $500. So now instead of starting with the original, $8,000 that you had in collateral, you would add $8,500 in collateral now. And that's kind of how you start stacking them. Plus, obviously, into that $8,500, you have your two premiums that you collected on the cash secured put and the covered call side. So how do you actually use this for retirement? How do I actually plan to use this for retirement? Well, my plan for retirement is to do this primarily on SPY, right? Why do I want to primarily do this on SPY? Well, if we look at the chart, SPY has always recovered. Now, just because it's always recovered in the past doesn't mean that it's always going to recover in the future. But for me, I believe it will. I have that conviction that it will recover and hit all-time highs again. Now, when we do this on SPY, the premiums are a little less and your collateral is drastically more, right? So if we sell a put here, right, let's say we'll go out to that 30-day mark, right? You could see our premiums are more, but our collateral is also a lot more. So for example, here, let's say I'm comfortable buying it at 554, currently trading at 561, right? But I'm comfortable buying SPY at $554. Well, for that, I would collect over $1,000 in premium. But remember, I would need to have $55,400 in collateral to do that, right? And that's why I like to look at this as a retirement, so to speak, because if I can open, 2, 3, 4 of these contracts a month, right? If I open like 4 of these contracts, I'm collecting $4,000, right, from an options buyer. Now, same thing happens here, right? If a SPY drops to 554, I would be on the hook with my money and my collateral to go out there and have to buy those 400 shares of it. But if it stays above this 554, the contracts would expire, right, in 30 days, and then I would be able to run the play again. Guys, don't forget, every single person is down below that comments is going to get our Theta TK playlist or action list. This is an absolute must read that I literally just talked to one of you guys in the comments about yesterday, but I put it together because I think it's so important for you guys to really understand theta decay and how it ties into all of this stuff. I recommend giving this about a year, this strategy. I know we kind of went over a lot in a short period of time, right? But just dive into the channel, dive into the other content to bring yourself up to speed. This really is a game-changing strategy, but like anything in life, it does require a lot of education up front. And if you're somebody that wants a little bit more of a handheld approach on building out your option selling portfolio, consider taking a look in the description of our 1-year incubator program. I do recommend this is about a 1-year thing because, again, we're not trading a lot. We're trading a handful of times every single month. So to really gain that experience and see different kinds of scenarios and how they play out, it does take about a year time. So take a look at that down below in the description of today's video. Guys, remember, sell options, collect premiums, repeat. I'll see y'all tomorrow.